Here are 3 reasons why to subscribe to Fridge Financials on YouTube. Number 1, it is free, which is the best price that you can pay for this kind of content. 2, I am completely transparent with all of my investments. And number 3, I have a variety of educational videos every single week. Now let's get on with the video. What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are going to be talking about what was I thinking about opening a SPY call credit spread, basically to bet against the market returning positive for the month of February. If you're excited for today's video, make sure you smash the thumbs up button, subscribe to the channel if you've already done so, and make sure you turn on the bell notifications for all future uploads. Your support has been absolutely fantastic. I'm going to continue to create awesome content for you guys. Any comments, any feedback you have, please make sure to leave them down in the comment section below, and make sure you spread the word because I love each and every single one of you. So what I'm doing here, first things first, I want to acknowledge how bad this trade was on my part as a reflection. First things first, basically what this is doing is it is betting for me to say that SPY or the S&P 500, it's an ETF that tracks the S&P 500, will not go above $504 for the month of February, or it's going to close below that for the month of February, which is the 29th. It is a leap year. Now, here's where my first mistake was. With this ETF and with, the S&P 500 in general, right? What it does is it shows you what's weighted in this ETF here. And I opened this trade up on Thursday right before the market closed. Right before it. It was like 15 minutes beforehand. And I was like, yeah, I got this down. It's a new month. I'm going to show you why I'm going to open this trade up. But I did not account for what companies were announcing the earnings. And that's my big issue, because we had 3 major tech companies that are on this top 10% that announced their earnings right after the market closed. So that was stupid, because Apple announced their earnings. Luckily, they missed. We're down about 2%, 3%. I forgot what it was. Amazon announced their earnings, smashed it, was up 6%. Meta destroyed their earnings, announced a dividend, was up 20% the following day. So these companies right here weighed up and took this ETF up 1.4%, which basically pushes it closer to my break even, which makes me start to lose money. So my first mistake with this trade here is I did not account for the earnings that were to be announced. And that is my mistake, because if I had waited, I could have pushed my break even a little bit higher up and probably secured hopefully more profits. But I did not. So we live and we learn from those mistakes. First mistake. Anyways, what I'm doing with this trade here is I'm betting that the S&P 500 will not go up past $504 in this ETF here. The reason why is thanks to a trader that I watch on YouTube who sells options, and his name is Max Options Trading. And what he did was he talked about selling options from a statistical perspective and a standpoint. As somebody who's a math teacher who teaches statistics, I jumped right into this video and I was like, I gotta know what he's talking about, because this is what I do basically on a daily basis. I talk statistics, I analyze numbers, I analyze data, right? So what he did was he focuses on saying looking for patterns in the previous, historical returns of the market can help you make some good decisions to put the probability even more in your favor than before. What I mean by that is this. So here's the S&P 500 right now. Now, as you will see here, we just closed out we're in the weekly indicator right here. So we have closed out on the 4th green week in a row for the S&P 500. That's the month of January. So first week, second week, third week, fourth week. January had a great rally to start the year off. Okay. When you look at previous data, right, besides this, because this month of November, December thing was just absolutely ridiculous. It was like boom, 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 boom. This is what, 1, 2, 3, 4, 5, 6, 7, 8, 9 green weeks in a row, which is very uncommon to hear from the markets. Okay. You look at anything from the previous returns, you get 1, 2, 3, 4, 5, and then a little bit of selling off. You go 1, 2, 3, 4, 5, a little bit of selling off. You can trace this all the way back to, looking at October 2021, 1, 2, 3, 4, 5, and some red weeks to sell off. The difference is in what people tend to kind of relate it to is gambling and the ideas of like the roulette wheel. Like, it doesn't matter if it hits this many times in a row, because, they're independent, right? You can get black 14 times in a row as a color on the roulette wheel, and then you lose all your money. The difference is that with this market is that people take profits. And when they take profits, you have money coming out of the market, which relieves some of the prices and makes a little bit of a selling off happen. Okay. The difference is that markets can't only go straight up. They have to come down. Okay. Markets cannot just go right to the moon, straight up 14 green weeks in a row, and nobody bats an eye about it. You know, you look all the way back to all these data values here, right? You got 1, 2, 3, 4, 5 green weeks and then 3 red weeks. Okay, so again, a little bit of selling off here. That's back in 2020. You've got 1, 2, 3, 4, 5, 6, 7, and then again a little bit of a selling off week, and then 1, 2, 3, 4, 5, and then a little bit of selling again. So again, you're looking at these kind of patterns here. Now, some patterns, obviously, this is not the best idea to do. 1, 2, 3, 4, 5, 6, 7. That's because there's a huge crash that happened right around here, I believe. So I'm starting to see that the S&P 500 is starting to get this, you know, this bullish trend again. It's going up. It's got 4 green weeks in a row, right? Now, can it repeat itself and go up 5, 6, 7 weeks? Yes, it absolutely can. But besides this, right, we're seeing that's been 4 green weeks in a row. This right here, these two things I want to talk about is why I'm going against the market here. Okay. The first thing is this little website I found right here, which I think is really cool. What it does is it's tracked the average return for the S&P 500. This is over the last 74 years, from 1950 to 2023. And as you will see, January on average returns about 0.91% over a 74-year period, right? So the more data you have, the more statistics you have behind it, the more you can make a good judgment and a good decision basing off of previous experiences. January on average returns 0.91%. So with me knowing that knowledge, I wouldn't try to bet against it in January. 44 up years compared to 30 down years. Are you able to have a down year? Yeah, absolutely. They had one 2 years ago at down 5.5%. You know, 2021, same thing. But then again, you had 4 years in between where it was green until then. So what you want to focus on is using statistics and using data to your advantage, right? So when you're looking through these data here, February, the average return is negative 0.17%. I think that's not even that much, Fridge. Like, it could definitely come up. Yeah, look, it could. Yeah, last year it was down 2%. The year before that was down 3%. 2020 was 8.7%. That was COVID times, I want to say. Oh no, 2019 I think was COVID times, I think. I don't remember. Anyways, so 41 up years compared to 33 down years. So a little bit more of like an even playing field, right? Instead of going from 44 to 30, it's 41 to 33. So we had 3 more down years compared to January over this last 74-year period. The more data you have, the better off you're going to be. And before you say, well, Fridge, that doesn't really tell you that much. That's definitely true to an extent, but look at the rest of the months. March, 0.96, positive. April, 1.45%, positive. May, 0.17, positive. June, 0.04%, positive. July, positive. August and September are always known for being negatives. So September is the worst month in the year, for obviously historically speaking as well. But August and September are also 2 more negative months to look at. But then October, positive. November, start to get that holiday rally. December, Santa Claus rally. And we go back into the new year after that. So out of all 12 months here, we're looking at only 3 months that the market has an average return that is negative. So August, September, and February. Okay, so there's something there. Like, you can't just be like, oh yeah, obviously you can have these crazy returns, right? But if you look at all these crazy returns, I don't think one of them is above double digits. No, none of them are. I don't know if this one is or not. I guess not. But I mean, the point is behind this is that when you're analyzing this, you're looking at, okay, this is putting the ball in my court, right? On average, you're going to have a down year or down month in February, right? On March, you're going to have an up year. On April, you're going to have an up year, right? February's going to have a down year. My first indication is that you get a huge rally in January. People take profits early on in the year to secure and to lock in those gains. That's my initial thought process to it. Obviously, that could be completely off, but that's what I'm looking at right now, is that saying, if I'm up, if I have a year like last year, I'm up 6%, I might just take some money off the table in February and secure those profits and then kind of readjust and go from there. So February is one of the 3 months that you have an average return that's going to be negative. So that's why I was like, okay, I might be bearish for the month of February, right? On top of that, so on my Instagram page at Fridge Financials, of course, awesome content. I know, trust me. I love the new logo. So that logo is absolutely awesome. But I have a couple pictures here, right? So one of these pictures here, if you look at this one from My Weekly Stock, great guy, has amazing content on his Instagram page. So make sure you go follow him if you aren't already doing so. But look at all the data here. This is from 1964, so it's not even as far back, right? So it's not even as far back, but again, the average return in February is 0. It's break even. Like, it's not going to go up. It's not going to go down. It's going to be at break even. The average win rate percent is 54%. It is the third worst one. September is the worst. July, for some reason, which is really interesting because it's 0.8%, but July is 53% return, and then February is 54% return. So in looking at these time periods here, I would definitely not go against the market March and April from historical returns. That's the way I'm looking at it. I wouldn't do this, right? But again, as you know, January is up over 2% this month on the year. So again, that's fitting into this green rate you have here. And I'm thinking that February might have a little bit of selling pressure here that might come into play. So what does that mean? Well, if this market starts kind of, pull back a little bit, people be like, oh my God, this is coming in way too hot, because look at this. It's already up 4.54% on the year. People might start taking some profits. People take some profits. This market's going to come back down a little bit. This market comes back down a little bit. Then this option might go into profit and make me having some money for the long run, right? So what my focus is here is that not even to bet that's going to go down entirely. So if you take a look at my contract here, 29th, I sold an option at 504 right here, 505. I have two contracts actually. So it's $200 in collateral for a $34 return, which is a 17% return for the month on my $200. As you will see, first of all, the chance of profit isn't even that low right now. Right now I'm sitting at, about a 70% chance according to Delta. So, I mean, again, that's because of the crazy rally we had on Friday, which again, my mistake. But, this market has to rally has to close 2.63% for me to break even, and then close 2.77, almost 3% on the month. So I'm not even saying that the market has to go down the whole time. This thing can go up 1%, 2%, and I'm still securing the profits by the end of the month here. But as I gave myself that little bit of extra room, and I made sure to be like, you know what? Okay, let's give it like a 2.5% return. I think it was 3% when I first opened it up, and then had a crazy day. Let's give it like a 3.5% return. First day was bad, but it's putting the numbers in my favor because, again, statistically speaking, based off of historical returns for February over the last 74 years, 64 years, to however many years you want to look at it, these markets are returning negative. So why not be like, you know what? Let's bet that it can even go up, but it's cool. As long as it go up a crazy amount, we're taking profits. Also, there's a lot of psychology behind even numbers for trading options here. So what my indication is that we have probably at $500 is where a lot of strike prices are, a lot of take profit values are. 500 might be this big wall here. So the fact that I have $4 more up on top of it gives me that extra room for support and give me that extra room to manage my trading and see what happens. So it might hit 500 and people are like, oh my God, it's at 500. It's a historical mark. It might just sell off and then we might just be good and then we might just be able to secure our profits and go from there. So these are some of the indicators I'm thinking about, when I'm opening these trades here. I'm not just being like, yeah, let's guess and hope for the best. This is what I'm really focusing on here. Now, with SPY here, I want to pull up another great post. This one is from Early Bird Options here. And he also does a lot of day trading, more than trading like weeklies and monthlies. He does a lot more day trading, but he brought up a really interesting point for a chart here. And it's this data right here. A solid January could have bulls smiling. The S&P 500 return, January return, greater than 2%, and what happened next? So all these data points here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32. So we're looking at about like 32 data points, right? So 32 data points, again, the more data you have, the better. It's not like it's like 2 or 4, it's 30 something data points, right? When January returns a better than 2% return, look what the rest of the year return does, right? So when we start off the year with a great January return, we have an 84% chance of the market returning higher at the end of the year, and the average return is 12.3% with a median of 13.4%. Obviously, there's some red days here, 1, 2, 3, 4, 5, but you have over 20-something data points of the market returning green for the rest of the year. That's not including the 2% in January. This is after January already happened. So here's what my thinking is behind it, because as you will know, the month of January up to January 31st, the market returned 2.27%. So over 2%, so we fit in that category. So now, historically speaking, the statistical edge is that the market is probably going to return a good amount for the rest of the year, and it won't go down. So what my logic is, and again, I haven't done this just yet, I'm going to wait until February is over, because that's usually known for being historically red compared to the other months, is that if I wanted to go all the way down to December 31st, and I want to say, you know what, I'm going to bet that it will not go below where it's at right now, which is 493. So it will not go any lower than this. If I sell a put option, I don't have the cash to buy that, because that would be $19,000, which I do not have. And then I buy a put option underneath it as collateral. I would make $32 on $100 per trade. That's a 33% return to basically just be like, as long as you don't go negative for the rest of the year, you are still getting profit, my friend. And to me, that is putting the numbers in your corner, right? My break even would be $492. Again, if it goes down 0.19%, then I would be breaking even. But again, this is where I start to lose money. But again, I'm only expected to lose $67 and make $33 for one contract. You know, if I really wanted to go bold and crazy with my trading ticker challenge, I could literally open up like 15 contracts of this, and that's $1,500. And I could be like, yeah, let's do that and see what happens. I can go 25 contracts if I wanted to, and I can make $800 with $2,500 in collateral. I'm not going to do that, but I could if I wanted to, if I really want to go bold and bearing. But again, you're putting the numbers in your favor. You look for those statistical and historical returns and see what the market does on average. So that is why I'm basically essentially hoping that the S&P 500 will not basically have a crazy good return for the month of February. It might still do it. And you know, if I have to close this off for a loss, I'll close it off for a loss. But I'm trying to give myself that edge to give myself that 17% return possibility on $200, which to me I think is a great trade. So hopefully that gives you some insight on today's video. If you made this far in the video, of course, make sure that you smash the thumbs up button as always and subscribe to the YouTube channel if you've not already done so. I hope you guys are making money in the market, and I will see you guys in the next video.